banks first. So I think we will go across to Vishnath to give us the details. The presentation came in late last night, so it'll be good to understand the three-pronged strategy that they put out, Vishnath.
Yeah, so primarily this three-pronged strategy is based on the size of the asset. First is for the MSMEs, where the outstanding debt is less than 50 crore. There, the bankers have agreed to go by a 90-day resolution plan. Within 90 days, if they come up with a resolution plan and if they're able to properly implement it in a company, then well and good. But if that 90-day period gets breached, then the account goes into the NCLT. Bankers have also suggested creation of a steering committee, which would ratify this process and which will see if banks have actually followed a due process. This can happen at an individual bank board level. Doesn't need to be a sector-wide sort of effort to resolve the case. For cases between 50 crore and 500 crore, it's a slightly bigger assets, where most likely there's going to be some consortium or some multi-bank lending arrangement. There a lead bank would be chosen depending on the size of the exposure of each bank. And an intercreditor agreement would be signed where they agree that if 66% of the lenders have pushed for a plan, then that plan goes through, just like how it works in the IBC. It would be applicable on everybody. Similarly, there's going to be a steering committee here as well, which looks at the process and which tells you that the process has been followed properly. These two are okay, but the main part of the plan comes in now for accounts which are 500 crore and above, which is the AMC structure that the finance minister had talked about last month when they created this committee of bankers to look at feasible ways of doing this. This AMC, as they're suggesting, will be a bank-led model. That's what the finance minister and the remaining bankers clarified repeatedly. They said the banks could take part in the equity of this AMC. There could be some foreign funds, there could be some infrastructure investment funds, all of these people together set up these AMCs. AMCs tap in to the AIF market for funds, and then they buy assets from the banks. According to them, this is going to be a completely independent process, which means the AMC will have the freedom of choosing what assets they want to buy and what they do not. They'll do due diligence and accordingly decide. And once they have bought the asset, then they can appoint specialists and turnaround specialists and industry experts who will come and help them manage these assets. In the same process, ARCs, which are currently in the market buying assets largely, they will also be allowed to participate, and it will be a fair, open auction process, and thereby, assets will be allotted to whoever pays the highest amount of money. In all of this, there is no security receipt system involved. They say, the finance minister said that within 60 days, all security receipts will be paid off to the bankers, and that they will not be ending up holding a lot of these receipts by the end of the process.
All right. I think, we've got a bunch to discuss on this, but we've got some reactions coming in as well. So perhaps we should get those in first. Mr. V.G. Kannan of the IBA is joining us. Good morning, Mr. Kannan. Thanks so much for taking our call. I think, we're going to cut straight to part 3 because, from what we can see, part 1 and part 2 is fairly procedural stuff that should already be happening in banks. What is the purpose of setting up this independent AMC, sir? There are already asset reconstruction companies in the market. There are stressed asset funds in the market. What is this AMC going to do?
See, what's happening is all these ARCs which have been purchasing assets, they have been, not all of them have actually been purchasing the entire piece of the, loans from all the banks. Many of them have got some 30%, someone's got 50%, someone's got 60%, but don't have the entire piece. Now, the idea of this particular AMC and ARC is going to be that all the debt from the banks move to the ARC after the due haircuts, as the case may be. And the AMC structure will also examine what are the ones which are viable, which will be run, and which will be managed. There are 2-3 ways of doing it. Either it could be run in-house, that is, you have specialists who are in-house who can manage the entire thing. Or alternatively, it can also be outsourced to some reputed concerns. The main focus is going to be not on the management itself, but on the funding. The funding is going to be 100%. I think the process, if you have actually mentioned, is this particular structure will assess the project, give a price, say 30% haircut or 25% haircut or 40% haircut, and then give a 15% upfront payment and give a commitment that within 60 days I will pay the entire amount.
Okay.
Once this commitment is given, it will be thrown open to all the other ARCs if there are any others who want to bid. And they will have to match or they have to better this particular bid.
Okay, so I get that. Mr. Kannan, sorry, I'm going to interrupt you because there are various parts of it. So you just said that unlike the current ARCs, which may buy, say, 20%, 30% of the loan amount, this AMC will take the assets off the bank's books. So that is a bad bank then, right?
Not actually even a bad bank, because it will have a haircut. No, it's not a bad bank in the sense that the entire thing will be taken over without any haircut. In the case of bad bank, the entire thing is taken over as a without haircut. Here there will be normal haircut. It will be an in-house company which will run it. It's not a question of only parking the asset, but also to run the entire thing. It will be a setup where the focus is going to be on managing the company.
Mr. Kannan, my apologies for interrupting you, sir. This is Menaka. But, you know, there are two bits to your response that I'd like to question you further on. One bit, you're suggesting that these assets will be moved to the AMC post a haircut. Now, that decision on a haircut in itself is the tricky part, right? If banks were able to take a decision on haircuts, we wouldn't have so many assets moving to the NCLT or the IBC. That's part one. Secondly, you know, I mean, whether it goes with a haircut or without a haircut, this still is a bad bank structure, isn't it?
It's not.
Did we lose Mr. Kannan? Well, it looks like we've had some trouble with that line, and we'll try and connect back with him in just a minute or so. But, you know, it just seems to me if they could make the decision, correct me if I'm wrong, guys, because you track this so closely, but if they could make a decision with regards to the haircut, then we wouldn't be facing the problem that we are facing today, right? Isn't that the weakness or a flaw in the design?
Yeah, A, that, and B, I mean, I'm not sure how who's going to make this decision. I think Mr. C. Venkat. Okay, we've lost Mr. Venkat Nageshwaran as well. But there are two questions. I mean, if this is going to all move to this AMC, it is a bad bank.
Yeah. Whatever you call it. Okay, let's for a moment assume that they don't want to call it a bad bank.
My question is why? Because it sounds bad. I mean, it's obfuscation, right?
Yeah, the bank where NPAs go. Let's call it that for a moment.
You can call it whatever you want.
The bank where bad loans go. Let's for a moment just change the nomenclature and call it that. The point still is, how is this workable? And that's the question. If bankers have not been able to fix this decision on haircuts so far, why are they magically suddenly going to be able to take a decision on haircuts and then transfer the asset to an AMC, which will then thereafter try and monetize it?
I don't know, Vishnath, you have an answer. I don't.
Honestly, I don't, because this is a topic that we've been tracking for years now, and the same argument has come up whether banks agree to a certain price as the right price. And most of the deals do not go through because of that reason. Now, for some reason, yesterday the bankers committee that spoke with the finance minister was fairly certain that through this process they would be able to sell or at least offload these assets, and they kept using the words offload, which I'm, you know, it makes me think if bad bank is probably the right nomenclature to use, because if you're offloading, if you're taking off the assets of the bank books, it is the bad bank.
The only thing is not at face value; it's at a haircut. That's the only thing. But who is going to determine this? You know, I think they made a conscious effort to call it independent. But who is making these decisions of what is the haircut? This is a bank-owned AMC. So you have to be very careful about that. There is potential for conflict of interest there.
So the banks are on both sides?
Of course.
So the banks are on the sides of selling the asset and the banks are on the sides of buying the asset.
So there is a conflict of interest there. I mean, they can say it will be an independent board, etc. But if that's the case, there is arsenal in the market.
This is kicking the ball down, kicking the can further down the road.
To another entity.
Yeah, you just basically took it off your books and moved it to another entity, because this is the bank selling assets to an AMC.
This was the very same argument. This was the very same argument given to for Arcel, by the way.
Yeah, let's put that question to Mr. Kannan. I think he's joined us back again. So we're just wondering how this is going to work, because effectively banks are on both sides of this deal.
Let me tell you one thing.
It's the bank selling the assets to an AMC owned by banks.
Please understand, the assets and the AMC or the ARC, as the case may be, will be, the equity will be subscribed to a nominal extent. It will not be a full extent owned by the equity. Equity will be a nominal portion. There will be a lot of funding. A majority of the funding will be coming from another institution. It may be AIF.
Sir, where will the funding come from? What institutions are we referring to here? If there was a line of institutions waiting to monetize all of these assets, we would have seen that monetization happen already.
You know, the issue in the past was the entire sale to ARCs was fragmented. So you had 3 banks which are selling, 4 banks are selling, 2 banks not selling. So you have never had a scenario where
but
the
that's
entire...
because banks, sir, were never able to come to a consensus. If they were, all these schemes, CDR, SDR, etc., would have worked.
Quite true. But at this particular point of view, all the banks, in the case of CDR, SDR, etc., there were still cases where some of the banks' assets were performing, or at least on paper they were performing, and the company was working, and therefore they could not actually sell it, and they would not like to sell an asset which in the books of the bank was performing. Now, in most of these accounts, the accounts are all become NPAs. Therefore, keeping it alive only blocks the capital, also makes more provisioning. So now what's going to happen is there will be 100% buyout, but it will not be a bank which will be subscribing to the equity 100%. The banks will probably take about 5 to 10% only of the equity in the other ARC, AMC. The remaining funding will come from AIFs, etc., who will be taking the stake in that particular company. It could be in the form of equity, or it could be in the form of a very low-cost debt, and which will assure a fund the purchase of the asset, and then it will be managed. Therefore,
Mr. Kannan, let me ask you this then.
It is wrong to say that the banks are owning the AMC. They are not going to own the AMC. They will have a small portion. It is sort of a commitment, say that I am party to this, therefore it will be a nominal amount.
Okay, let me ask you this then, Mr. Kannan. You're talking about assets being moved in their entirety, 100%. We are at 10 lakh crore in NPAs. Even if you say a small proportion of that is moving to this AMC, the kind of funding that this AMC then requires, so where are you going to get it from? I mean, you know, if it was that easy to draw in these institutional investors into, stressed asset investing, there are lots of platforms, lots of ARCs which would have done it. What gives you the confidence, sir, that you'll be able to raise that funding, and what is the quantum? Do you have a number in mind, sir?
See, I can't really other any number, but I am given to understand that the members of the committee and a few others have had interaction with some funds who have committed, saying that we will be in a position to participate in, provided the assets are of a particular quality, in the sense that they are running, they are worthwhile, but not sustainable. So what actually will happen is the sustainable portion of the debt will move into this particular company, and then the unit will be managed by a professionals, either in-house or maybe outsourced to some companies which are already running similar activities. So the purpose is actually to ensure that you get a funding from outside. It will not be a funding by the bank, which is the normal misunderstanding we have. More than 75-80% we expect funding to come from outside the banking system itself.
Mr. Kannan, sorry, this is Vishwanath here. Just wanted to clarify. You said sustainable portion of the debt will move, but earlier you said about 100%. So
no. Sustainable portion means obviously it will be 100% of the debt with the proper haircut, which basically means the sustainable portion. Every person will buy a particular asset at a discount of 20%.
Can you give us an illustration? If there's an NPA with about 100 rupees of outstanding loans that they're unable to service, how would this then fit into this structure? Can you give us an illustration so we can better understand the point?
The new structure will say, I'll take 65 rupees. Okay. I think that 65 rupees will give me a good return, and that over a period of 3 years or 5 years. And since I know the business of running this institution, I can run the institution. I will fund out of 65 rupees, maybe 50, 55 rupees. I will take it from the other funds, 10 rupees from the banks as some sort of a participation in it, and that will be serviced over a period of time. And then this particular thing, since they become the owner of the debt, they can either repay it, or they can they'll become the owner of the
So these are the steps. Mr. Kannan, if I understand this correctly, the steps are that banks convert their debt into equity, then transfer...
No. Again, you are putting words in my mouth.
No, I'm asking you, sir. I'm simply asking. Okay.
Suppose the debt of a particular bank is at 20 rupees. The equity in that will be maybe half a rupee or 1 rupee.
Okay. and they transfer, let's say 65%, I'm just using that number as a ballpark, they take a, you know, a 35% haircut, they transfer 65% to this AMC. This AMC has got, let's say 10% funding from banks and about 90% funding, you're saying, from other institutional investors. They could be all kinds, ARCs, foreign investors, whatever. And then the AMC manages the asset and hopes that the asset recovers, and over a period of time, you know, is hopeful of being able to make a profit, or at least recover that 65 rupees of debt that has been transferred to the AMC.
Yes.
Is that the...
There are other ways also. And subsequently, once they find that it is working well, they continue to run it as a separate company and sell it off to a third party. Once there are attractive buyers who can take it over, like what has happened in the NCLT process.
Okay, Mr. Kannan, I have a last question, or two small last questions. Question number one, to set up a structure like this will take, what, 6 to 12 months? If so, the first round of, the first list of RBI accounts is out of the window. That is not going to have any benefit from this structure, perhaps the second round or subsequent NPAs. And second question, and the most important, has the RBI cleared this, sir?
Why should the RBI come into picture? It's got nothing to do. This is a normal structure. We are not.
So an ARC, if it's an ARC structure, the RBI would need to clear it. And if banks are putting equity into an ARC, the RBI would need to clear it, sir.
No, see, that's why I'm telling you it's not going to be a huge amount. So we are examining this particular portion. But say there are already existing ARCs.
Yes, sir. And RBI clears all of them, sir. An ARC license has to be cleared by the Reserve Bank.
Correct. So that they will examine the possibility of having either using an existing ARC or thing, but the setup or the concept is going to be this. So whether it's going to be new ARC, in which case you are right, it may take a longer time. They could also tweak an existing ARC to and take it forward, in which case you don't need to have a separate license.
All right, Mr. Kannan, we appreciate the effort you've taken this morning, sir, to try and explain this to us. I assume that this only applies to accounts that have not yet been referred to the NCLT. I mean, I think that is a silly question to ask, but nonetheless, to clarify that these are accounts that have not yet been either referred to NCLT or are not on RBI's second list of, waiting to be referred to NCLT or under the IBC process. Correct, sir?
I think you are more or less right, because unless the process if the NCLT process is already underway, I think it may be a bit too late to refer it here.
So it's only for those accounts that the Feb 12 circular applies to, where 180 days the clock has started ticking in some fashion or the other.
And that straight away it can become up.
All right, Mr. Kannan, thanks very much for joining us this morning. Look, guys, correct me if I'm wrong, but this means that banks have to take a haircut. So we're back to square one, right? This is what they had to do with CDR, SDR, everything else. So that still is the iffy part of the, sort of design situation. And this also assumes that there is investor interest in such an AMC.
It assumes there's investor interest. That's point number one. Point number two is this is going to take at least 6 months on an optimistic note to actually set up. Point number three is, what is the purpose of this? What are we trying to do? This doesn't resolve anything, right? You need capital. You get the capital. If it was that easy to get capital, why can't banks rate private capital in the market?
I'm going to interrupt you there. We have the Managing Director of State Bank of India, Rajnish Kumar, joining us this morning. Good morning, Mr. Kumar. Thank you very much for joining us.
Good morning.
So can you talk us through why you think this third arm of Sashakt, the one that deals with accounts of 500 crore and more, is likely to succeed, whereas all other schemes that have relied on banks making a decision to take a haircut and that have relied on external investors coming in to be able to fund these assets have failed so far, sir?
Basically, what the thinking is that first, the analysis of the current situation, where there are 2-3 problems which are being faced by the banking system in resolution of the stressed asset. The biggest problem is fragmented decision making, and there are too many banks in consortium and multiple banking. There is no forum as of now which has any legal sanctity. So through an intercreditor agreement, the attempt is that all the banks come together, be bound by certain ground rules, and take coordinated decision and consolidate the asset. The second question comes is that ARC's capability to buy out any big asset, one single ARC, because their capital may not be sufficient. And the third issue is about the redemption record of the ARCs, where the redemption record has not been great. So the committee has tried to address all these three questions, and that is why this suggested mechanism of AMC, AIF, ARC structure, where the ARC will upfront will have the backing of an alternative investment fund who are willing to fund an asset. They move in coordination, and the asset, once it gets consolidated, and if there is an AMC which is managed by competent professional, the resolution, chances of resolution will be much brighter.
Mr. Kumar, this is Vishwanath here. Sorry. Firstly, to create such an AMC structure, yesterday the finance minister repeated this point that you don't really need any special law or any provision in the regulations to actually create this thing. Why is it that banking sector had to intervene, or bankers such as yourself had to say that we are willing to put in the first stake, and then probably that should push the remaining private sector to come up and create these structures that will take over the assets?
Right. So there is a felt need for an asset management company which is professionally run and which can manage large size assets for resolution. So that is the felt need, and somebody has to take the initiative. And as the finance minister mentioned, and as has been recommended by the committee also, we are looking at an AMC with a very wider participation from private as well as public sector. And private sector definitely will be holding more than 50% in the AMC. And let me clarify that AMC does not require any huge amount of capital. It is a fund which will be registered with SEBI. There the funding requirement will be considerable. And again, there the participation from the banks, domestic institutional investors, as well as the foreign institutional investors who have interest in stressed assets. So it is hoped that they will participate.
Mr. Kumar, why is this any different? I mean, I saw the presentation specifically says this is not a bad bank. Essentially, sir, it is. You want to park these assets in another entity. You're not calling an ARC for some reason, I'm not sure why. You're calling it an AMC. But essentially, banks are looking to park their assets. And I also think, sir, that there is some amount of conflict of interest involved here, both in the fact that the banks will hold equity in the AMC and also because this is going to be a market maker, you're saying. How is there not a conflict of interest, sir?
No, there is no question of any conflict of interest because, number one, I agree with you that because everything is within the existing framework, regulatory framework or legal framework, so why it is not a bad bank? It is not a bad bank because the assets, when they are being sold at a market-determined price. So that is the key difference. The question always comes in that when the asset is being sold, so there will be a loss, and that loss will be borne by the bank upfront. It is not that the asset is being transferred at the book value and a bad bank will provide the capital and take over this asset at book value. To that extent, even today, the banks sell assets to ARCs, and when they sell the assets under the proposed arrangement also, it will be a sale to ARC and it will be through open bidding, through inviting expression of interest. What is the key difference you have to understand with the proposed structure or the suggested mechanism is that in the suggested mechanism, it is that under an inter-creditor agreement, the banks will take a uniform approach. So if an asset is to be sold, the idea is that it is sold to a single ARC so that even at ARC level, the asset gets consolidated. Otherwise, today, even at the ARC level, a asset can be sold to different ARC by different banks. So that is the first key difference. Second is the ARC should be paying the banks within 60 days. The SRs have to be redeemed. And if that has to happen, the ARC would need a backing from a fund. And a fund, when they invest, they have their AMC. So it is a combination of three. So key difference is that three things, AMC, AIF and ARC, they are moving in coordination, and the sellers, the banks, they are also moving in coordination. And when asset gets consolidated at one entity level, one fund, one AMC, then obviously the decision making will be much faster. As far as banks are concerned, as I said, that at the time of sale itself, whatever is the provisioning gap, that gap, banks have to bear that loss or book their loss in their books.
Mr. Kumar, if I could just follow up with two questions that, question the premise of the success of this plan. One is the part where you've said that this inter-credit agreement creates a formalization that did not exist before. But sir, under the various resolution schemes of the RBI, there was already a formality to how banks came together and attempted to restructure assets, which involved banks taking a decision on what haircut to take, which banks failed to do, as a result of which we have so many assets that are currently under the insolvency proceedings at the NCLT. So why should we presume that when banks have for years now failed to be able to take the decision in a consensus on what haircut to take, whether under the CDR scheme or any other scheme that required them to sit across the table and take that decision in consensus, suddenly now because of this structure, they will all find consensus and be able to make that decision? That's part one. The second part of this solution that I'm confused about is, what private sector money are you expecting will come to the table, given that this money has already been around but has not yet come to the table? So why is it that we are expecting that suddenly there's going to be renewed interest in being able to help banks resolve this?
So one is, to answer your question, before 12th February circular of Reserve Bank of India, GLF mechanism was prescribed by Reserve Bank of India. It had some sort of a regulatory backing. After 12th February circular, the GLF mechanism has been discontinued. So definitely the banks, when there are more than one bank, and in some cases there are as many as 40 banks, who and in what manner do the banks come and take action with consensus? So in the absence of any regulatory mechanism, ultimately it is upon the banks then to work out a consensus arrangement and work out the rules through which they are willing to work.
But sir, the JLF mechanism has not worked so far. Otherwise, we wouldn't have seen so many assets in insolvency.
No. Right? It is not correct that JLF mechanism has not worked. There were issues around delays. Let me tell you. And why we expect that now the delays will not be there? Because the resolution framework of Reserve Bank of India itself puts a time limit of 180 days. So if in 180 days lenders do not come to a consensus on any resolution plan, then in any case the asset lends into NCLT. So that 180 days is coming from regulatory guidelines. And the second is that if an inter-creditor agreement is approved by all the boards of the bank and the ground rules are laid out, and through the inter-creditor agreement, the consensus will be that 67% by value, if the lenders agree on a particular course of action, that will become binding on all the banks.
Okay, I understand, sir, the need for an inter-creditor agreement now that the JLF mechanism is out. So under this, effort of being able to either resolve or go to IBC, you've created this inter-creditor agreement. But the second point in this is that, where is the buying interest going to come from? And I think in your first response, you suggested that this AMC, ARC, bad bank, whatever you want to call it, will have up to 50% private sector investment and up to 50% public sector investment. Is this, what is the, how is this AMC going to get funded? And to what extent? Do you have any ideas of what the amounts involved are?
let me tell you, there is a huge interest in the stressed asset resolution as far as the institutions or banks are concerned.
In your estimate, sir, what are the amounts involved that the AMC will need to be able to deal or to be able to get off to a successful start?
Yeah, so if you look at the presentation, this 500 crore and above, the estimate is about 3 lakh crore. So the amount needed would be that what is the average percentage estimated recovery. So the amount can vary. If
so
say we presume
60%,
that, suppose it is 40%.
40%,
right?
Okay, all right.
Right?
Yeah.
So you need 1,20,000 crore.
So the AMC will have to 1 lakh. So the AMC will have to have 1,20,000 crores, right, sir?
The funds.
The funds, not in capital. I understand the funds.
The fund 1,20,000 crore is what you need at 40% recovery.
So how much of that do you estimate will come from, let's say, foreign investors, AIFs, all kinds of investors, except for existing banks and financial institutions that are plagued with this problem?
Right. So one is, number one, in any alternate investment fund, the bank cannot participate for more than 10%. And it carries a risk weight of 150%. So when any bank decides to participate in a fund, it will depend upon, number one, their risk appetite. It will depend upon their investment policy. They will have to take into account the capital requirement on account of RBI guidelines, where the risk weight for the investment in any alternate investment fund is 150%.
Fair enough. So back of the envelope calculation. Back of the envelope calculation, 1.4 lakh crores. How much will come? 1.2 lakh crores. How much do you expect will be generated from external investors? And by that I mean people that are not banks or financial institutions already plagued by this NPA situation.
No, leave aside the bank, but the expectation is at least 70%, 60 to 70% should come from domestic institutional investors and banks, and 30 to 35% should come from the foreign investors. And as I said, there is a huge interest in the stressed asset market in India, and there is every possibility that this type of funds can be raised. And it is not that you need it in one day. The funding will be required over a period of 6 to 24 months at least, because they do their due diligence, pick up the asset, and then fund it. So let us see how things unfold. But money is not an issue till such time the IRR expectation of the funds who will invest, if that is met, there will be interest.
Okay, Mr. Kumar, one last question and very short ones. What is your sense of how quickly this will be up and running? Because, 2 years back, this would have made a lot more sense than it does today. And two, I don't understand, Mr. Kannan said that this doesn't have anything to do with the RBI. I don't understand how. Has this plan been discussed and cleared by the Reserve Bank of India, sir?
No, the committee chairman did meet the RBI officials, and the copy has been given to RBI. But the committee, when drawing the plan, have ensured that whatever plan has been prepared, it does not seek any dispensation or any forbearance from the regulators, primarily which means Reserve Bank of India. So whatever has been suggested or recommended, it is within the existing regulatory framework. That is very important to note. And that is what Mr. Kannan or the committee or whoever has mentioned, that we don't need any, or the banks would not need any special dispensation from anyone, either the regulators or the government. So that is true.
And how long will it take for this fund to get set up, sir? I just point you to the experience of the National Infrastructure Investment Fund, which took 2 years, if not more, to actually get into action.
So as I said, that as far as intercreditor agreement amongst the lender is concerned, right, that we will move very fast. On AMC, there is interest, And the hope is that within next 3 to 6 months, we should be able to see the first deal coming through. Particularly, there are many power assets where there is an effort to at least revive those assets or keep those assets up and running, where the PPAs are available, fuel supply agreements are available, and many more PPAs are expected from the state governments. So power sector is one where I believe that it can take off very quickly.
So this marries your Samadhan scheme with the effort to resolve the larger NPA problem.
Absolutely.
Okay, I have one final question, sir. You said of that
That was the first final question.
No. I have one more. You said the 1.2 lakh crore amount that we were talking about hypothetically would get funded about 60 to 70% by domestic financial institutions. Who are you referring to, sir? Because banks would not be, the bank exposure would be very, very limited from the PSU bank front. The private bank exposure might also be very, very limited given where they are today and given how many of these private sector banks don't even want to be involved with some of these assets. So are you suggesting that it will be insurance companies and pension companies of some sort?
There are many players, and even banks will.
So who are these many players that have much money?
Is it LIC?
Yeah, thank you for asking the question.
State Bank of India, we are willing to participate.
But you can only participate up to a restricted extent, right, sir?
At least 1,20,000 crore, if I presume so, 12,000 crore can come from State Bank of India alone.
But then you'll be spending your own money to buy out your own loans, right? Effectively, sir.
No.
What about LIC, sir? Are you reaching out to LIC?
So we will reach out to everyone. That as I am saying, that it is not such a huge amount of money, and you don't need it in one day.